Here are the 3 option strategies that I trade every single week to help me make more than $1,000 a week. You can see here from my Tastytrade account, if I come in over the last 60 days, you can see here I generated over $12,000 in options premium, which equates to about $1,500 every single week, purely using 3 different strategies. So what are these 3 strategies? We need to understand what the market is. The market can do one of 3 things. It can either go up, it can go down, or it can go sideways, and we should have an option strategy designed to make money in each one of those points. So when it comes to a bullish market, when the market is trending up, I run one specific strategy. When the market's bearish, I have another strategy that I run, and then just every single day I run what I call a daily income strategy. I run these 3 combined because when you combine them, they work well and you know exactly what to do at any given point. That's why a lot of traders lose money, because they don't know what strategy to trade at the right time. And so that's exactly what this video is going to teach you. So let's dive right in. So when we're looking at a stock chart, we need to be able to identify what the market is doing and what phase we're in so we know what strategy to run. If we go to indicators, whether we're on our broker or a platform like this, like Tradier that I'm using, type in indicators and go into Bollinger Bands, and that's what we're going to use. This Bollinger Band indicator is preloaded like this. We want to go into the settings and actually make a quick change and change the default 20 length to 200. And this makes it very clear what the market is doing at any given time. This shows us the overall macro trends of the market, especially when we look at it on a daily time frame. When the market or the stock or whatever we're looking at is in this range right here, this is a bullish range. This means the market is making higher highs and higher lows, so we're going to run a bullish strategy. When the market's down here, we're running a bearish strategy. It's when the market is headed down. When the market is down here, it means it's overextended to the downside. It's gone down too far, too quickly, that it's going to bounce up. So that means in here, we're running bullish strategies below this green line. Above this red line, it's the same, but the opposite. It means we've pushed up too far, too high, too quickly. So we're most likely going to pull back. And that's when we're going to run bearish strategy. Bearish, bullish, bearish, bullish. That's how we know at any given point what strategy to run. So over the last 60 days, as you just saw from my Tastytrade account, where I made over $12,000 in options premium, most of it has come from the bullish bot. At least $10,000 of it has come from the bullish bot. We've had no bearish bot running because the market has been bullish the last 2 months. Bullish has made all of it, and daily income has made a small portion as well. So now you may be wondering, Austin, what are these strategies that you're talking about? So let me break down each one of these strategies so that you know exactly how to implement them for yourself. So the bullish strategy is quite simply a put credit spread trade. A put credit spread trade is a very simple bullish strategy that has defined risk. This means whether I'm trading with a small account or a large account, I can change how I trade it. Now, I always love to do my put credit spreads either between 30 and 10 delta. This helps me know what my win rate will be. Well, at a 30 delta, that means I'm going to have roughly a 70% win rate. So if I'm okay with that, I can go there and collect higher premiums. If I want to do something with a higher win rate, I can go to 10 delta, which would give me roughly a 90% win rate, but I'd make less money. Either way, a put credit spread is the best way to go with a bullish strategy. You can also do something just as simple as selling a put, buying a call, or doing something more advanced like a 1-1-1 strategy, which I would do with a futures options approach. But with a simple put credit spread, the way that I structured is I do a 10 delta for the put that I'm selling, and then I buy the 5 delta to define my risk. I manage this trade at a 50% take profit. The reason why I do this is because when I do put credit spread trades or any long-term trades, I'm going like 90 days out into the future, which means it's going to take me 2 weeks to a month to actually close that trade. And so if I'm putting on a new trade twice a week, I could have 50 trades open at a time, and I don't want that much risk. So that's why I'm keeping my take profit short at 50%, so that I'm closing trades quickly, so that I don't have as many trades open at one time, so that I can decrease my risk. So that's why I have a smaller take profit running there. And for my stop loss, I'll do anywhere from 200 to 300% stop loss. Typically like the default to 300%, but if you want less risk, you can easily go 200% as well. So that's the bullish strategy that I'm running inside of my accounts. Again, this bullish strategy is what's going to make up most of the weekly and or monthly income. It's going to come from this strategy right here. So make sure this is traded well and only traded in bullish markets. The bearish strategy, again, I've had no running with it quite yet, but the bearish strategy is quite simply the inverse of the put credit spread. It's a put debit spread. Now you might be wondering why a put debit spread over a call credit spread. Both of these make money when the market goes down. A call credit spread, though, would struggle because if the market drops, volatility will increase. So we not only want a strategy that will take advantage of the right market direction, but also off the volatility change. A put debit spread would make money when the market drops and make money when volatility increases, being a double whammy there to help us generate income quickly. So a put debit spread is the strategy that I run for that bearish. It's going to be a simple 30 delta, and then again, depending on how much I want to do, I can change the one that I'm selling. So I'm buying and then selling 30 delta buy, and then I do about 20 delta that I sell to define the risk. And this is a simple 14 to 30 day out trade. I typically do around 21 DTE. Just knowing that, hey, this crash will probably last about 3 weeks. Most do. So I like to run it about that. There's no take profit, no stop loss on it. The goal is just to let this trade play out because it already has defined risk. So I know what my profit or loss will be given a situation. I can always, though, take 90% profit, 80 to 90% profit. This is what I may do if we're having a very hard crash. The reason why I do this is because you'll only be able to collect so much profit, even if you're right on the trade, just due to the time left in the trade. It's called theta. And so you'll probably only be able to collect 80 to 90% of it. So if you've collected 80 to 90% of it and you still have a week or two left in the trade, it might be best just to close the trade. You'll take the max profit that you basically can, and then you have money to reinvest or basically just to take off some risk in the market. So these are the two strategies that are going to make me the most money from all these strategies combined. But the problem is these strategies do take a while. They take anywhere from 2 weeks to a month to close. And with that, traders can get in trouble by trading other short-term strategies because they have an itch to trade. They're watching the market. They're doing things like that. And because they're ADHD, there is another strategy that I like to use to make sure I have daily activity, daily trading volume. That's not going to make me super rich, but will help add a cherry on top outside the profits that I'm already making from the bullish and bearish spots. That's called my daily income strategy. It's basically a 1 DTE ORB strategy. What this means is it waits for the first hour of the day. Whenever the market breaks the high from the first hour, it's then going to enter a 1 DTE put credit spread trade. So again, it's a 1 DTE put credit spread trade where it sells to 35 delta and then I buy $20 below it. Again, you can change that based on the amount of risk that you want to take. So that's that trade. It's managed at a 40% take profit and has roughly a 50% stop loss in that trade. And these are the 3 strategies that I'm using every single week, every single month to help me generate income. Why? The bullish takes over bullish markets. Bearish helps me hedge during bearish markets, and daily income is that cherry on top to bring in that daily activity and daily cash flow. Anyways, that is the whole thing. If you want my actual trade plan for the daily income strategy, click the first link in the description in the YouTube channel, and you'll be able to get access to my PDF version of this trade plan so that you can use it to start trading tomorrow. All right, guys, see you in the next video.